Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So we came back from the holiday weekend. Foreign markets were strong during the U.S. market closure due to Memorial Day. We came in this morning, we gapped up, but we didn't have that gap and go like maybe some people expected, some exuberance on this big gap. We have started to build sort of an upper level wedge pivot type pattern. If you subscribe to Scott Redler's morning note, we sent out a little afternoon update talking about that pattern that's building both on the daily chart and the 60-minute chart. We can go ahead and take a look at the chart here to take a look at the action I was talking about. This morning you can see we had that big gap up, not really on much of anything. We had a nice, we basically found our footing late last week after that big outside day sell-off and that big gap down the following day. On that big gap down, it was really important to see how the market reacted, and that 21-day moving average is an important level that we watch often. We held that 21-day Friday. We held the level again, and then obviously this morning we had the gap up, and we weren't able to blast off. So what that tells you is that the market's really not ready to break down, but it's not ready to break out, and what that leads to is indecision and a wedge type pattern, which is one that we talk about a lot, that traders love to see wedges because it provides very defined levels for them to base their price entries and exits off of to manage risk and to manage entry levels. So you look at it on the daily chart, you look at it on the 60-minute chart, which is the other chart that we sent out in that afternoon update to Scott's morning note list. And you see a similar type pattern developing here with that wedge. You draw your lines here. So you really have a nice little area to measure composure right now. If we break below this wedge, it could trigger more downside down into the 21-day moving average again, perhaps. If we break above it, it could be back to highs. But as we said in the afternoon update, the market wasn't really ready to have those new high headlines and have that new high type mentality yet. I think people still are sort of figuring out what to make of that outside day we saw last week, and not ready to really commit to taking a ton of profits right now, but not really ready to commit to buying another somewhat shallow dip after a really strong start to the year. Besides that, the market was somewhat quiet on a stock-specific basis, except for a lot of the names that we've been watching and paying attention to recently that have really been active and providing active traders a lot of volatility that, if you can figure out how to trade these stocks, you could potentially do really well with them. And if you're talking about that group of stocks, you have to start with Tesla. Tesla has obviously been a huge mover. I started talking about it back in the $40 area, and I was reading a couple blog posts today. A guy, Abnormal Returns, I think was the guy who was talking about it. But some people in the blogosphere had the similar thesis as I did when it was back in the $40 area, is that it had a 50 or 60% short float, which is obviously huge. And the company had been showing signs of turning a corner, both with their financials, actually starting to make money, and with their car technology. And they sort of had a double dose of good news that ignited that big squeeze, and they had their first profitable quarter, and then they got a 99 out of 100 rating from Consumer Reports on their Model S car. Even though the Model S remains a little bit too expensive to be too much of a mainstream type car, I think it really opened a lot of people's eyes and gave the company a lot of good publicity. But we go back to the daily chart here of Tesla. We're going to get off my line tool here. We go to Tesla. You can see here, huge move today in Tesla. This is back in the $40 area when I was talking about it. It gapped up on that earnings report and then made a huge move above the pivot from that earnings day. And I thought it was a big move when it went up to the $60 area, and then the next earnings report came out, the gap and go, hasn't really looked back. And when you have such a high short interest, it can really ignite monster moves that go a lot further, a lot faster than you could ever imagine. And what you had here in Tesla, the most recent entry that a lot of traders have been watching, was this sort of descending channel bull flag type situation, where once you got a break out of this descending channel, it was another situation where the shorts were going to be on the run and the bears were going to be scrambling. And we got a huge move, and it hasn't looked back from that either. On this day, on Friday, on Friday, it traded back up to the highs, and then today it erupted again. There's talk that Tesla could try to compete with the Nissan Leaf, come out with a sub $40,000 electric car to try to corner that broader market. Obviously, I don't know the percentage move. I'm not going to do the math in my head right now, but it's off to the races for Tesla again. It's a situation where it's tough to chase Tesla after this monster move today. But if it can base, if it can form another flag, there's no reason why it can't go higher. I mean, the fundamentals on this stock are completely out of whack, but there's a lot of situations, like when you have a high short float, that things besides fundamentals drive the trade, and it's the mechanics, it's the short float, it's just the mechanics of supply and demand when you have a small float and you have a lot of people naysaying the stock. And I wouldn't pay so much attention to the fundamentals right now. I'd pay more attention to the technicals, and it's more of a short-term active trader game right now at these levels. In terms of a long-term, put it in the drawer type of stock, I wouldn't at these levels. But as Scott has said many times, and as we said in the morning note this morning, if you're a short-term guy and you're not watching and trading Tesla, then you're doing yourself a disservice. So I would definitely get familiar with it. Go on the virtual trading floor, watch what these guys are doing with Tesla, and you could potentially have some success with it, I think. We'll stick with the Elon Musk theme and look at SCTY. Elon Musk is the CEO of Tesla. He's the man of the hour right now. He's a genius guy. He's 40 years old. He's a physics guy who also got his MBA from Harvard, so he's sort of got the business and science departments covered thoroughly. And SCTY is his solar venture, SolarCity, where they sort of have a different business model than a lot of the other solar stocks. That the other solar companies require big upfront investment in solar equipment to get started, which is a little bit prohibitive for a lot of people. SolarCity leases their solar materials, solar panels, and things like that, and that model's proven to be successful. And it's another situation like Tesla that had a huge short float, and once it started breaking above key pivots, it's just no looking back and continuing to put shorts on the run and really having them scrambling. Today, however, while Tesla was able to erupt and break out, SCTY got rejected at its previous pivot high, and had a harsh down move, engulfed Friday's move after opening sharply higher. So this is really a day to take notice in SolarCity. You had last week a day to take notice in the market that didn't lead to huge downside. But what you do is you use your short-term moving averages to gauge the composure of it. The 8-day moving average is still above there, so that's healthy to see the 8-day play catch up. You have the 21-day all the way down at 36 or 37 area, which it wouldn't be unhealthy to see it retest the 21-day either, but that would be a big percentage move. It would be almost a 25% move if it got back down to that 21-day, but I wouldn't really be surprised to see that. One thing to really take note of in SCTY is that the IPO lockup expiration ends on June 11th. And when a stock IPOs, certain people that get involved in the IPO have to hold the stock for at least 6 months, and that period ends on June 11th. And a lot of times you can see people head for the exits really quickly that are stuck in that lockup. So something to be aware of. I'm not saying necessarily that June 11th is going to come and it's going to be a slam dunk short, but I think leading into that lockup, you'll have more talk about that. Then once the lockup expires, I think that could be something to pay attention to. Once again, I want to say, like Tesla, this is not one. The fundamentals don't line up with the long-term story of I'm going to put SolarCity in the drawer. I do love Elon Musk. I love what he's doing, but this is one for short-term traders. It's a short-term trading vehicle, in my opinion, right now. And you are doing yourself a disservice if you don't trade it and watch it on an intraday basis, if that's the way you trade. So be in the virtual trading floor. Look at guys like Mike Lee, Steve LeVay, and even Mark Sperling, and those guys are getting involved because this is just too much volatility not to get involved with, to be honest, with these stocks like Tesla and SolarCity. But keep an eye on SolarCity, especially heading into that June 11th IPO lockup expiration. We'll stay in tech with a couple more familiar names over a long-term basis. LinkedIn, I tweeted last week about it. I think we included it in the morning note. This new product that's been great. I keep talking about it, but if you're not subscribed to that, I would definitely sign up. It's a free newsletter we're sending out every morning. You get a snapshot of the futures data. You get all of Scott's most actionable and favorite chart setups, or at least the commentary from the stocks that he's watching most closely, in addition to all the links to our videos and an annotated S&P chart. But I digress. Back to LinkedIn. LinkedIn I talked about as one of in my mind, an A-plus short setup. The narrative has started to change a little bit with LinkedIn, is that it's been a Wall Street darling. Almost every earnings report, it's exceeded expectations, except for this most recent one. And you had it soaring into that earnings report above $200. People were anticipating another blockbuster report from LinkedIn, but they couldn't maintain that momentum and that pace that they were keeping up as a business. You saw the gap down. The gap down was sold. It didn't break those key upper level floor type areas initially, but it wasn't able to really bounce significantly. You had, sort of a 3-day attempted bounce here that ended in a, topping tail type candle, led to more downside, and now you have the 8, 21-day and the 50-day moving averages starting to curl down. Today you saw extreme relative weakness from LinkedIn. If it breaks this upper level floor, I really do think it's look out below for LinkedIn. I think it's one that it has a really out of whack PE. I know PE, it's sometimes can be a misleading statistic, but I think in this example, LinkedIn, things have gotten a little bit too out of whack, and I think the shorts have been squeezed as long as they're going to get squeezed, and I think it's time to head in the other direction. And I think we could get some downside. I could even see it getting back to the 200-day here around the 145 area if we do get a break of that upper level floor in LinkedIn. Definitely something to keep an eye on from a short-term trading perspective if shorting is your type of thing. Another one in the same group. We've been lumping these together for the past several months, Netflix and LinkedIn, because they sort of followed the same path in terms of their earnings, but Netflix has started to separate itself a little bit from LinkedIn because the most recent earnings report from Netflix was another good one, while LinkedIn's was not as good. But Netflix today was very weak, just like LinkedIn, and it also has its 8-day moving average starting to curl down after sort of a toppy type candlestick up here when it had an outside engulfing day after it gapped up back here on May 16th. And it's traded lower. The 8, 21-day are curling down. It's below its 21-day now. You have the 50-day come in here. I mean, this is a natural support area on the short term for Netflix to come into, this 199 area. So I would definitely look for a trade down to there to fill some of that gap from this most recent earnings report. It's another one, though, that I wouldn't be surprised to see it get down into the 170 area, between 160 and 180 in this little range. And that'll be a very important area for Netflix to hold for long-term composure. I do like the Netflix story. They're sort of leading that new media revolution. But I think, like LinkedIn, the shorts have been chased perhaps as far as they're going to go. Where Tesla's still sort of in the midst of that short squeeze. I think these rallies in LinkedIn and Netflix are reaching more of a maturity stage, and I tend to lean more to the short side if I were to be involved with them. Staying in tech, Amazon is one that Amazon's like a cat. It's got 9 lives. Every time earnings come out, they lose money. The company's not yet profitable, but they still continue. The stock still continues to charge higher. It's frustrating a lot of times for traders, I think, because just when they think it's going to break down, it's when it reverses and rallies back up. So I would beware of that and maybe be prepared for a little bit of range trading in Amazon. I know a lot of guys were watching it today because it sort of has, if you zoom out, you can see it more clearly, just another upper level descending channel, or you could call it a bull flag type pattern, that if it does break above, we'll get our line tool out, if it does break above this trend line right here, you could get some momentum. But it's like I said, it's one of those stocks that's really frustrating for a lot of traders. I think that when it does look like it's going to break above a range, it accelerates and then it reverses back and gives a really harsh move. And then when it looks like it's going to break down, finally break below its 200-day moving average, for example, we zoom back in. A lot of traders, after that really weak earnings report this time around, saw this harsh down move. It had sort of what looked like a dead cat bounce, and then it traded down again, but then it traded right back up above its 200-day moving average, and it's back in that range. So Amazon's one that I would keep an eye on. I know a lot of other traders are, but really a tough stock to trade sometimes, so not really on my A list, I wouldn't say. We're going to take a look at the TLT right now, and a very popular topic over the last several years is the possibility of a great rotation from bonds into equities. People have been talking about a potential bubble in the bond market. People are still piling into bonds despite the low yields because people are still jittery about the world economy and the financial crisis, all that type of stuff. And the thesis is that once confidence returns a little bit to the economy, once things start to improve and people are chased more into risk assets due to central planning and central bank activities, that bonds are really going to see a big downfall, big down move. And you're starting to see, from a technical standpoint, a very clear head and shoulders pattern develop that could foreshadow that big move if you're a pure technician looking at patterns like that. Now we go to the chart, you zoom out. This is one that we'll talk about a little bit more on the blog, maybe in a morning note. We'll do a post about it, but you can see a head and shoulders pattern forming here on the TLT. The neckline's here. This is on the weekly chart that I'm looking at. You have your head right here, or you have your left shoulder right here, your head up here, and you sort of have a right shoulder forming here. And that measure and move would take you down to around the $100 area. You know, if we get off our line tool, I'll zoom out a little bit. And that $100 area would be sort of a natural level of support for the TLT if it did get that big breakdown. You know, those are levels that it was around mid-2011. So, you know, it wouldn't be an end of the world type move for bonds, and in the grand scheme of things, you know, bonds I think they've enjoyed a really successful run, and it wouldn't be surprising to see a little bit of air come out of those at historically low yields. You know, I think people are chasing performance right now. They want something that maybe gives them a little bit more yield, a little higher performance, and I definitely could see this happening. But you know, when too many people start talking about a bond bubble and the potential for the great rotation, I think that's when it doesn't happen. And I think that narrative has started to quiet down a little bit, and that is maybe why we could get finally that breakdown in the TLT in long-term bonds. Another one that is sort of responsive, I think, to central planning and Federal Reserve meddling and all that type of stuff is gold. I think it's a really interesting case right now, and my general theory on gold is that the amateur investor should not try to trade it like it's a stock. There's so many forces at play with the GLD that we don't understand. There's, you know, big sovereign funds that play in gold and buy dips and sell large blocks, and it's hard to really identify when that's happening. You can a little bit in the price action. Obviously, we saw this huge breakdown above a key macro support level. Maybe that's evidence of some really big players getting out of gold and some funds perhaps unwinding their gold positions after some underperformance by gold recently. But in general, the narrative has switched a little bit from, you know, unlimited QE to QE tapering, and when are we going to stop, start paring down the size of these QE purchases, because the voices have grown louder about the potential negatives that could come with QE and the stuff that's going on in Japan and stuff like that, and people are warning about currency wars and all that type of stuff. And I think there's also a little bit more of a commitment to looser fiscal policy, is that you had austerity was sort of the soup du jour for a while in Europe, and there was, you know, even a push within our own Congress for cutting the budget, things like that. But now austerity is sort of being pushed away, pushed to the side. Even Germany is sort of abandoning that austerity camp. And I think as you see fiscal policy loosen up a little bit and you see governments more willing to increase deficit spending, that's what Ben Bernanke and people on the Federal Reserve have been calling for a long time. So you get a lot more bang for your buck with fiscal deficit spending than you do through monetary policy and growing the Fed's balance sheet. So I think the Federal Reserve might feel a little less pressure now with some measures being taken by governments to boost world economic production and world growth. And I think that's a net negative for gold. If monetary policy starts to tighten up a little bit, you do get QE tapering and that narrative continue to grow. And I'm of the opinion that gold is going much lower in the long term. It's hard to say whether there's going to be dip buyers in the short term or some forces that are going to be at play in the short term. But my general thesis with gold is don't try to day trade it. Don't even try to swing trade it, because you're going to get big gaps and big gyrations that are due to factors that we don't know anything about. If you're going to have a thesis on gold, make it a long-term thesis, either be long-term bearish, long-term bullish. It's something that I generally steer clear of. But those are just my thoughts on gold and some macroeconomic factors that you need to consider when you're talking about gold. And fear mongers like to talk about gold as the ultimate protection in a case of a big world economic unraveling and all things like that. And what I'll tell you is the world only ends once. And when the world's ending, I don't want gold. I want maybe a bottle of liquor and a pillow, as Scott said one time, which I think were wise words. But anyways, I'll end that rant and I'll end this long daily recap. I haven't been in front of you guys for a while, so I figured I'd share some of my insights. Hope you had a great holiday weekend with your family. We're heading more into a quieter period for the market, so I would generally pare down my expectations and my risk into the summer months. That's something that every trader will tell you. A lot of Fridays in particular will be very slow. So don't be looking perhaps for some of the great action we've seen recently. I think look for things to quiet down a little bit. And after a great start in 2013, I think it's natural to pare down expectations. But this has been John Darsie here for your daily recap, and we'll see you out here tomorrow morning with the morning note and with the morning call video.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.